on this. All right. Okay, so this is Fuad. I'm a real estate agent for about 10 years. I've known Mike for maybe just as many years, or close to that as well. So Mike, introduce yourself. Let us know what you do, and so that we can get going with this interview.
Sure. Michael Dunsky, been in mortgage banking since 1988. I started processing loans back then. That's when they just invented the wheel. So we had typewriters on our desk. Guidelines and everything were a little bit different, but it's funny, nothing has changed in mortgage banking since I started except for the technology. So the premise is the same. The banks simply look for a reason to give somebody a mortgage based on their income, their assets, their credit, liabilities. And it's our job to make sure that each client qualifies for the loan program that they're looking for. So I've been doing this for forever now, 30 plus years. Processed for the first 4 years and then got on the road and started originating. And that processing background really gave me the knowledge to figure out what would work, what wouldn't work for clients, but also how to help clients structure their financial profile so that they can become homeowners at some point. And that's the goal, is to help people get into a home, achieve American dream of home ownership.
That's very true. So Mike, I know you're with which company now?
Fairway Independent Mortgage.
Okay.
And this is where I'm retiring. Not anytime soon. We just had 3 girls get married recently, so I won't be retiring anytime soon. But
congratulations.
Thank you. Now, Fairway's a great company. Fairway's been around since 1996, and the best company out there right now in terms of independent mortgage companies. And they have core values. One of them is speed to respond, and we know that sometimes in a real estate transaction, things come up that are unexpected. And it's not that you won't encounter problems. We all have to anticipate that we'll encounter an issue while going through the mortgage process, but it's how quickly you turn around and correct the problem, fix whatever the issue is. And Fairway just does a phenomenal job with their speed to respond. So it's a great company to work for. Plus our rates, closing costs, everything's super competitive, always at the bottom of the market.
Got it. Perfect. So I have buyers who come to me sometimes and they say to me, hey, Fawad, I've got Bank of America. I'm going to call them up and get a pre-approval from them, and other banks as well. So I've had very few transactions which have gone through there, because I've had people apply, get a pre-approval, and then what happens is that something gets stuck, paperwork gets kind of delayed. I'm not naming any particular bank, but then what happens is then in one particular transaction, they had to back out of a certain bank. And I said, you should go to those people who do mortgages day in and day out. Those are the people who are in the home industry, home real estate industry, and they don't lend out money to anybody. They are not holding deposits to people. They're doing this day in and day out. And when they switched over, very quickly, everything went straight into place. So could you, just for those novices, first-time home buyers, what's the difference?
It's funny. I think a lot of people feel that going to their bank where they have a relationship helps them in some way. And it doesn't. If you have a banking relationship with Bank of America, that's great. Unless you're a super high-end net worth client, they don't know me from you, from anybody else. So you're treated the same as any consumer with them, which is great. I can't speak for other lenders, how they operate, other banks. I can just tell you from my own experience that we know we need to move quickly sometimes. And maybe the loan officers at the bigger, more commercial banks, maybe they don't have as much experience as some of the other loan officers that work for independent mortgage companies. Not all. There's some very experienced people there, but their systems are just set up differently. They do car loans, they do checking accounts, they do home equity loans. But those are all a different animal than a mortgage. A mortgage is extremely specific, set of guidelines, all sorts of different guidelines, because there's so many different mortgage programs out there that they just may not be as familiar or knowledgeable or set up for the type of lending that we see the economy needs right now, which is not everybody fits into one box. Not everybody will qualify for this loan. Some might have to go a different route. And we have all those options, which is, I think, what separates us from some of the bigger banks.
Yeah, that makes a lot of sense. Could we segue now, because of what you just said, into the fact that there are different loan programs available to people, so that we can just get a little bit of familiarity that it's just not one way to be able to do this?
Exactly. Everything from 0 down payment loans to, the sky's the limit how much you want to put as a down payment. But there are programs out there like USDA. USDA is a great loan program.
Hmm.
It started off as from rural development, our rural development government agency.
Yeah.
They basically said that, and it started off for farmers. Farmers wanted to buy land, and so they wanted to buy land in rural areas, and that's how USDA loans were set up, where the farmers didn't have much money to put down, but they wanted to start their farming business.
Oh,
And that translates over to the general public now for residential housing. But USDA is specific to location. So you have to be in areas that are a little bit more urban, but you can buy a house with zero money down. First time buyer programs, Fannie Mae and Freddie Mac, people think they need 20% down. They don't. If you're a first time buyer, you can buy a home with as little as 3% down.
hmm.
So the down payment really allows for different options. The more money you put down, the more options are available for you. But there's a lot of misinformation out there where people think they need to have a larger down payment. And so they're waiting to buy until they save up money. You don't need 20% down. Again, 3% down, even 1% down.
Hmm.
And the way this works is, so let's say there's a state bond program where Massachusetts Housing Finance Agency, you can put as little as 3% down, but you as the borrower can put 1% down, and Mass Housing will give you a loan for the other 2%.
Wow.
So you can really buy a home with as little as 1% down. So
Wow.
you don't need a lot of money up front necessarily, but you need to qualify for those programs. Somebody may be interested in USDA loan, but there's some nuances. So you really have to dive down with your lender a little bit deeper, go with a lender that knows what they're talking about, that studies the programs, because even though their loans are available, you may not qualify. It might be in the wrong area. You may make too much money for those loan options. So really ask your lender, what programs do you have available for first-time buyers with less than, let's say, 5 or 10% down payment?
Perfect. Got it. Yeah. Um, and obviously there's after the loan programs, like you said, you can put certain amounts of money down. Um, can you talk to us about PMI? Again, a very basic question for you and for me, but for other people, like, what is PMI? Why do I have to do that? Yeah.
PMI, this is private mortgage insurance. So PMI is mandated. It used to be when mortgages started, people who were looking for homes and banks started lending out money. It used to be way back when um, that you needed 20% down. The banks wouldn't give you a loan unless you could put
Oh,
20%
I
down
didn't know that. Okay.
across the board. But then what happened was we got the Federal Housing Finance Agency, FHFA. They are in charge of Fannie Mae and Freddie Mac, who write the rules for all mortgages.
Hmm.
And Fannie Mae and Freddie Mac says, look, you can buy a home with less than 20% down, but if you do so, we need you to have this extra insurance for the bank or the lender.
Hmm.
We need you to have this extra insurance in place in case of a default. So if somebody defaults in their mortgage, the bank is actually able to recover some of the 20% down that the borrower did not initially put down.
Hmm.
So it's just an insurance program for the banks, for the lenders, to allow them to have people buy homes with less than 20% down, but also guarantee a little bit of the down payment coming back to them, or their equity in the home coming back to the banks should a default occur. So they will never be whole. The banks are not in the real estate business. They don't want to take your home back. They want you to be making your payments on time and be very successful with your mortgage. But we do know that life happens, and some people do end up getting foreclosed. And this is really the way that the government really, for Fannie Mae and Freddie Mac, will help the banks be sustainable should there be a number of foreclosures that they have to eat.
Yeah, that's true. Perfect. Yeah. Now, what are jumbo loans?
Jumbo loans, that's a great question. Jumbo loans are different in certain areas. And the only thing that defines a jumbo loan for a conventional loan is basically the loan amount itself. So if we have clients buying in, let's say, Worcester County,
Yeah.
and somebody is going for, a regular loan, I think it's 726,000 and change is the maximum limit for a conforming loan in Worcester County. However, if they go above that, then it's just considered a jumbo loan. And there's different guidelines, different criteria. The credit scores typically need to be higher for a jumbo loan. It's going to be a better risk. So the restrictions are a little bit deeper. You need to have more money in the bank for reserves. A lot of times they look for different credit profiles, meaning having 3 or 4 accounts that have been open for at least 5 years or so.
Mm.
So they look for different things to qualify for a jumbo mortgage. And interestingly enough, right now, the jumbo mortgage rates are actually lower than conventional mortgage rates.
Oh yeah,
So
yeah.
there's an advantage there in some cases, as long as, again, you meet the criteria for the jumbo loan program.
Got it, got it. What do I, if I'm a buyer, for example, I'm a first-time home buyer or even a second-time home buyer, what do I have to keep track of, for example, for in terms of credit history or how I handle my credit? What do I have to do to be able to make sure that, hey, time comes that, I want to get rid of this smaller home and go into a larger home. These are the things I need to be able to do to be able to be a successful profile for somebody like yourself to qualify me.
That's a great question. Number one, these are the do's and don'ts with your credit. Do not open any new accounts.
Mm.
There's a great sale at a furniture store and they're offering 0% financing for 5 years. Do not open that charge card. That's what that is. It's a charge card with a store.
Yeah.
Don't do it, because as you open accounts, your credit score drops for a little while.
Mm.
It comes back in time. But the same if you close accounts. Do not close any of your accounts. If you want to pay them down or pay them off, that's fine. Do
Mm.
not close accounts, because that subsequently lowers your score for a little bit. Don't change your spending habits. If you use your Amex for travel or for business or whatnot, keep doing that, but show the records of how you pay that off, assuming it's paid off every month.
Sure.
Those are really the big ticket items right now. And don't, it's funny. One misconception out there, people say all the time, are you going to pull my credit? Well, I can't issue a pre-approval unless I have your credit.
Yeah.
The misinformation that's out there is people feel your credit score is going to plummet if
Right.
a mortgage
Right.
company checks your credit.
Right.
That's not the case. If we do a credit check on somebody, a hard credit check, your score changes by 3 or 4 points. So we
Hmm.
would never put a client in jeopardy of getting the best rates and the best terms with having the highest credit score, because your scores are a moving target. Every time you charge something and it's reported to the bureaus from your credit card companies, that changes your score. Every time you pay something off, that changes your score. So anything you do with your credit does change your score, but having your score change by 3 or 4 points is negligible. It doesn't change anything in terms of what rate or terms you're getting. But also what people don't understand is that there's a shopping window that the credit bureaus give us and give consumers, so that they don't get hit with all these. If they're shopping for mortgages,
Yeah.
and they need to see if somebody will approve them, what the rates are, they can have multiple credit inquiries up to, I believe it's 4 weeks
Mm.
for mortgages, and it only counts the first one. So you can have unlimited number of inquiries and you're only hit by the 3 or 4 point deficit to begin with, nothing else further for the next 4 weeks. It's still not a great idea to have a ton of inquiries on there,
Mm.
but nothing is stopping you from checking out whomever you want to, be a good consumer and check out the rates and terms and so forth.
Yeah. Yeah. Is there a good credit rate? Is there a good credit number?
There is. It's changing. It's changed recently, but it used to be, up until recently, it used to be 740 is sort of the magic number. You have a credit score of 740,
Yeah.
anything above that, you're getting the best rate in the conforming world of mortgages.
Hmm.
That's moved up. It's at a tiered scale, basically. So 780 and above is going to get you the best rate. 760 to 780 might be a slight increase.
Hmm.
Seven in increments of 20 points, 740 to 760, 720 to 740, and so on and so on. Once you start getting below 700, those ticks go higher. The rate increases go higher. So ideally, you want 740, but if you can go higher, then go higher. What we also can do, one of the benefits of us pulling a hard credit, is we can tell the consumer, hey, our client, what to do in order to, I want to say, manipulate the credit. But if you want a higher credit score, here are the steps that you can take, because we can see it. And any knowledgeable loan officer understands the algorithms for hard credit inquiries. And
Yeah.
we can see on the report what needs to be done. Really good topic is, what's the number one? I think the number one weighted item on a credit score happens to be something called utilization.
Okay.
And utilization simply means, out of all the revolving debt you have available, meaning the high credit limits on your cards,
Yeah.
how much are you using? Are you using a lot of that? Are you using over 50% of that? Are you
Mm.
using 90% of that? I have a client with a $2,000 credit limit on a Capital One Visa, but their balance is $1,800. They're utilizing just about 90,
Yeah.
95% of the available credit. That hurts your score. So maybe if you bring that down to a $500 balance,
Mm.
and maybe move some of the balance to another card that has a higher credit limit,
Yeah.
that allows the score to increase. So a lot of things that we can advise somebody to do to help improve their score to get a better rate ultimately.
Got it. And the better rate is obviously something good, but should I be, if I'm at like 600 or 650, should I even approach you and say, hey, I want to buy a house. I don't care what the rate is.
If you have a 400 credit score, you should approach me.
Oh, nice.
Doesn't mean we can give you a loan right now, but you know what? Everybody deserves an opportunity. And you know what? Some people don't need a handout, they need a hand up. And that's what we try to do. As a loan officer, our job, we get paid for doing our job, but I love the job of helping people. So I can help somebody with a very low credit score. We can help them rebuild the credit, get the score up high enough so that they can buy a home. And you mentioned some numbers, 600 or 650 credit score. There are plenty of programs. We have programs that go down to 580 credit score.
Hmm,
Now, do you pay a little premium for a lower credit score? You do. Again, it's risk reward. But once we see the credit, then we're in a position where we can go ahead and assist you in taking steps to change your credit profile and help out.
got it. Got it. I wanted to get into you mentioned it before as well, that right now there's some news about uh, penalization because of a high credit score. This is obviously time sensitive and might just disappear later on for somebody who sees it later. But what is your thoughts about those?
Yeah, so let me go back a little bit. Yes, you are right. Nobody this is I'll start with the background. The
Yeah.
government's initiative is to help minorities get into home ownership because
Okay.
there's a big difference between the number of people that are minorities not in the housing market versus the non-minorities that are in the housing market.
Got
So
it.
their initiative is great. Applaud the initiative. What they've done is basically they're saying, and this has already been going on for several months
Oh,
because the official date is May 1st, where any loans that close need to follow these what they call loan level price adjustments. But it's been enacted, it's been incorporated into banking now for a couple of months.
okay.
So we knew this was coming.
Okay.
And what essentially happens is this: for first-time buyers, predominantly with lower credit scores and lower down payment,
Yep.
the interest rates that they would normally pay are going to be a little bit lower. The cost of the lending to them is going to be a little bit lower
Okay.
because what they've done, the government, FHFA has done this, Federal Housing Finance Agency. If you're a stronger buyer, and I understand why they did this, I don't like what they did, but if you are a stronger buyer with a better credit score and more down payment, you're not going to get as good of a rate as you could have, let's say, a few months ago.
Okay.
So there's a little bit of a cost now that was not there before to better borrowers, believe it or not. And now it doesn't mean tank your credit score intentionally so you get a better rate. That
I
doesn't
know.
happen. That
Yeah.
can't happen because with the lower credit scores, you're still paying a higher rate than with a higher credit score. It's just the people with higher credit scores, better risk, more down payment, they're getting, I want to call it a little bit of a tax. They're getting a little bit of a tax, but their rate is always going to be lower than somebody with a lower down payment and not as high of a credit score. So I've been fielding these calls for the past week because the media got hold of this and they've really blown it out of proportion. But
As usual.
I'm glad it's got attention because the way their initiative is great, their execution on how to do this really needs to, I think they need to rethink this because it's
Mm.
basically a tax on somebody who's been able to save more money and been able to come up with a large down payment, or I don't want to say be responsible with their credit, but having a better credit score due to whatever circumstances.
Yeah.
So it's a tricky road. I understand the predicament that the government's in, but they're basically subsidizing. They're subsidizing right now. But don't for a second think that you should lower your credit score to get a better interest rate because that's not how the fluctuation works right now. That's not part of the loan level price adjustments. A good qualified buyer going to pay a little bit more than what they could have, but it's still going to be a lower rate than the others.
Is it a humongous change between what they would have paid a few months ago to now? Are they
No,
going to be like, oh my God, it's going to be hundreds of dollars more per month?
no, it's not that significant. I mean, if you look at it over the period of a mortgage, it's significant. $100 a month is significant, but let's say it's $40 or $50 a month. Maybe it's an eighth of a percent difference in rate. In
Mm,
some cases, it could be a 1/4% difference in rate.
okay.
And on a $500,000 mortgage, that does add up over time.
That's right.
Um, so we're seeing how this plays out. This is an initiative with the great intention, but lousy execution. And I'm hoping that it gets revised pretty soon. but we'll see what happens, and I'll keep you posted.
Let me know. So during COVID, we were at really low rates, right? And then rates rose to, I think last year, October-ish or so, to like 7.5 or something or the other. I don't know. You probably kept track of that even more.
Eight,
Eight,
eight.
8%.
Yeah.
Right. And I was doing my new construction condos and activity just dropped right at that point, like middle of October, whatever it was. And slowly there was some things happening, but really it picked up middle of January, things started to pick up again. And it had a really good correlation to rates again, right? And then since then, I hear people, because people used to mention to me when that happened in October or close to that time frame, people used to mention to me, well, the rates were really good before, and I hope they go back, and they started going up. And they went up to like 8, like you said. And then they've kind of normalized to like 6-ish or 6.5 or 7. They've been fluctuating still. But I don't have people asking that question anymore because it seems like everybody understands now we are at a different trough and we are at a different level. And maybe like gas prices, it's become normalized or something. I know.
Yeah.
I'd like to get your thoughts on that. What do you think? Where do you think consumers are heading at for rates in the future?
Well, I'll go back a little bit. Just as you mentioned, back at the beginning of COVID, rates dropped. They did not drop by themselves. This had to do with government intervention. And what the Federal Reserve did, what they went on this program was they call it the quantitative easing. And basically what they did was, this is interesting to explain. So a mortgage rate is determined by a bond. A mortgage-backed security is a bond. It's traded on Wall Street.
Right.
And there's two components to a mortgage-backed security. And that is there's a yield and then the price. When there's demand, Econ 101, when there's demand for something, the price goes up.
Right.
Well, by buying these bonds, when the government decided to do this quantitative easing and buy a whole bunch of these mortgage bonds, the price went up. As a result, yields go the opposite way. Yields go down, and mortgage rates are tied to those yields. So the government says, what we're going to do is we're going to artificially increase the price of these bonds to get the rates down. And they were spending between $7 and $9 billion a week in buying mortgage-backed securities. They spent billions and could even be trillions of dollars. I forget the actual number, but they were spending an enormous amount of money buying these mortgage-backed securities to artificially bring rates down. And then when we saw the rates go back up to, high 7s, even 8s, not too long ago, that was the result of the government and the Federal Reserve unwinding that program and selling all of those bonds. So they initially artificially brought the rates down, and there was nowhere else to go. Who was buying the bonds when the government was releasing them? So the opposite impact. It was an unintended consequence of what the government did way back when. They overstepped before, and then they overshot again now. So listen, they've made plenty of mistakes. This is one of them. So what we saw was a big increase in rates when they dumped all those mortgage-backed securities. And what's happened now is that everything is starting to settle down, as you said. So we're back into a relatively normal market, but we're not down where we should be yet. The government I'm not saying they're not paying attention to the inflationary news and the economic news, but they're missing something right now. And we're going to see in the near future, we are going to see interest rates drop. All the economic reports that I've seen, and I look at Moody's Analytics, I also look at the Congressional Budget Office, it all points to lower rates coming very soon, either end of the summer, end of the year. Rates right now are in the middle 6s. We should be seeing those mid 5s, low 5s, maybe even upper 4s.
Okay.
But that might give somebody the impression, hey, I'm going to hold off buying a home till the rates go down. You can't do that because now we have another problem. We don't have a lot of inventory. We're probably 6-7 years out of having enough inventory to meet the demand.
Yes.
What that means is if you hold off buying a house today, you're going to pay more for it tomorrow.
Right.
Values are going to continue to appreciate for the foreseeable future, no matter what. And so you say, is it a good time to buy? It's a great time to buy because your values are only going to go up based on all the economic data, all the demographics out there. And that's a whole other show for us. But values are going to continue to appreciate. And you're saying if you're a seller, then I'm going to hold off selling. Well, the problem is we are going to see more inventory. We've already started to see more inventory come on the market. So why wouldn't you sell now? Because if you hold off, you're going to have more competition later on. And while the values are going to continue to appreciate, they may begin to appreciate at a lower pace.
That's right.
And that's something which it really should give the sellers thought, maybe now is the right time to do it, where I can get the biggest bang for my buck. Sure, I may make a few extra dollars later on, but I'm going to be in competition with other homes that people might find attractive.
That's very true. Yeah. So with the way that the market is going right now, if rates do go lower, you and everybody else is going to be saying, "Hey, I can afford a house now that I couldn't afford maybe 2 months ago or three
Correct.
months ago." And then so the amount of buyers who are going to come into the market is going to create that competition again. And
Yep.
then as if you're a buyer, everything's going to go up also. But the unpredictability of trying to sell a home now or later, it's I wish we could time the market.
Yeah.
Anybody does that probably makes billions and trillions of dollars, but I
Well,
don't think people are doing it.
I have my crystal ball somewhere. Actually, no,
Bring that out.
it's in the shop right now. My crystal ball is in the shop. So you're right. We can't predict the future. I look at the smart people to tell me what's probably going to happen. And these are all statisticians. They're all numbers people. So if you believe in the numbers, and I kind of do like the numbers, you have to follow the trends and follow the information. And if there's a consensus out there, I'm apt to believe that consensus. And that's what we're hearing. That's what we're seeing. And there's a lot of data out there to support the lower rates and the continuation of appreciation.
That's what I see everywhere too. I follow Keeping Current Matters a lot, and they do a Facebook Live, I think every 2 weeks or week. And that gives you the same indication. Everybody's saying the same thing. They're going to come down, things are going to become more affordable. Yeah.
Yeah.
But
So rates should be in a normal market, we would be seeing lower rates right now, but because we've come off the super low and super high, we're easing down. It's easing down. With the government stepping in, the Federal Reserve raising short-term rates, not mortgage rates, but short-term rates, they achieved and accomplished what they needed to. They were trying to stave off inflation. And while we still are likely to be in a recession, if they ever admit it, inflation has started to go down. And there is a direct correlation between inflation going down and mortgage rates going down. So what they did kind of worked in a backwards kind of way, but it did work. But we are seeing the results of that now.
perfect. Got it. I'm just going to look at my questions to see if I missed anything. Um, yeah. Yeah, no, I think we've covered everything that I want to do. Do you want to give something else to people? Real estate agents are probably going to see this, buyers are going to see this, sellers are going to see this kind of a situation. Any advice?
Yes. I think one of the number one questions I get on almost a daily basis from new clients, and this is it's a daily occurrence. Mike, how do I buy something if I have something to sell? Because in a market like this, if you have a home to sell, then your offer may not be as attractive as somebody coming in without having a home to sell. So it might not get into the right yes pile. It might go into the no pile when making an offer on a home.
Mm,
So the biggest question I get is, how do I buy without selling, or can I?
mm,
And the question is, we don't know until we look everything and take a deep dive into your financials. So we can find ways to bridge people over. People will say to me all the time, do you have a bridge loan? I say, yes, we do have a bridge loan, but it's not the bridge loan of days past.
mm,
Different types of loans that are very creative and nothing crazy like we had a few years back in '08,
yeah,
but just getting creative with the financing and using the equity in somebody's home right now or other resources to help bridge them over. They don't know that they have these opportunities or the availability to bridge themselves.
mm,
So that's probably the number one conversation I have with clients is, okay, let's take that deep dive and see, can you buy a home right now without having your home sold? And then the question is to me, oh, we can't afford, even if on paper I say they can do this, we can't afford to carry two mortgages. That's not the premise is to see about getting their offer in on something without having that home sale contingency.
yeah,
That's plan B. But plan A is to, once they get their home under agreement, to go put their home on the market to sell and time the closing so they never have to go through with it without carrying two mortgages. So there are creative ways to help people get into a home while they have a home to sell. But that's a challenge right now too, because chicken or the egg, do we buy before we sell? Do we sell before we buy?
yeah.
And they're all individual circumstances, but that's the number one question I get almost on a daily basis.
Perfect. I remembered something now. Pre-approval. So there's a pre-approval. If I apply to your link, I get a pre-approval. I speak to you, and you say, "All right, I've looked at this documents," and then that's not a very involved process. Is there a more involved process that makes my offer stronger to a seller?
Yes, well, I'll tell you, it is a pretty in-depth. I mean, I take a deep dive. I can't say this for all loan officers, but
Yeah.
basically this, pre-approvals come from the loan officer. They
Got it.
don't go through underwriting. There's no other, it's just based on the loan officer's experience. And 30 plus years of experience. I haven't seen everything, but I've seen quite a bit.
Yeah.
But it's not my first rodeo, but it's
Yeah.
kind of an involved process to do a pre-approval correctly, because
Okay.
if my name is on that pre-approval, basically I'm guaranteeing that borrower is going to get that loan. So
Hmm.
I look at I get their assets, I get their income, I get their documents, I get their liabilities, I get their credit, and I take a very deep dive looking at those, vetting everything out, making sure we're not looking at wrong or incorrect information, allowing, there's certain guidelines as to what income is considered qualified income. I
Yeah.
make sure it's all qualified income. Once I do that, and then we have a conversation, then the pre-approval letter is issued. Now, we have reversed engineered the process as well, because we want our clients to be in the best shape possible making an offer.
Sure.
So we have what's called a fairway advantage program. It's basically, we re-engineered the loan process. So not only do I issue a pre-approval, but then we send the loan up to underwriting to review. And
Oh.
once that underwriter reviews and agrees with my assessment of the income and the loan amount and the terms,
Hmm.
they stamp it with that commitment. And now we have, instead of just a pre-approval for a client, we have a fully underwritten loan commitment that they can present with their offer. And that should give the sellers all the confidence in the world that these are very safe buyers to accept an offer on.
Okay.
But we take it even a step further.
Hmm.
Once our clients are approved under this program and we have a loan commitment for a TBD, a property to be determined later,
Mhm.
we will offer a seller cash guarantee. We will buy that home from the seller if for any reason our client that we approved and committed to,
Wow.
if they cannot get their financing, we will put our money where our mouth is and buy that home on behalf of our buyer, and
Wow.
then sell it to them later when they can qualify.
That's a great
So
advantage.
if somebody loses their job 3 days before closing, and that happens,
Hmm.
and they no longer qualify, there was a client that we had. He worked at Silicon Valley, and about a week before they were supposed to close, he lost his job.
Got it.
So that was very tragic for them.
Yes.
But had they been approved under this Fairway Advantage program, we would have bought the house on behalf of the seller for them, or on behalf of the buyer. We would have bought that house,
Yes.
uh, and they would have received their money and proceeds, and we would have held that home until they're ready to qualify and buy it back.
Wow. That's really, really good. I guess it's all about communicating that to the seller's agent as well,
Yep.
communicating what you have done to be able to get to that level of certainty about their mortgage. Yeah.
Yeah. It's next best to a cash buyer. Obviously, we're not cash buyers, but if we have that approval, we stamped it, we agreed with the income, we agreed with everything, all the facets of that loan make sense and it works. We'll put our money where our mouth is. We'll buy that house.
Perfect. Perfect. I really, really want to thank you for your time, Mike. The reason why I refer people to you more and more and much more than other agents who are doing mortgages is because of that involved process, because you get involved and you look at everything else. And whoever I've spoken to have always said that it's really easy to work with you.
Appreciate that.
Probably all that experience, right? 30 years plus of experience, that you've seen a lot of stuff. So I also see that, I was rough when I started, right? And as you go with time, things get better. You get more encompassing uh, understanding of the whole process of, mortgage, inspection and everything else. So I really appreciate you in that way. That it's really been very helpful. Whoever's worked with you has been, kudos to you. Thank you so
I
much.
appreciate you say that. Thank you. And it's not me. I have a great team, so my team
Mhm.
deserves all the credit. But you have to talk to people as if this is something serious and that you're involved with, and you're going to give it all your attention, and also set expectations. So setting the expectations, as long as somebody knows what to expect, you're helping them through the process with ease, because now they don't have this on their mind. What about this? What about that? How much money do I need? What are my payments looking like? We address all that up front. But then the real work comes in when the loan process is going and my team is involved and they're experts at this, and they do a much better job at it than I could. So they get all the credit. They deserve all the credit. It comes to me, but they deserve all the credit.
That's
But
great.
thank you.
That's
And
great.
thank you for the opportunity today too. I hope this helps somebody.
I hope so too. I think it will.
Great.
Thank you so much, Mike.
I will be back in touch when my crystal ball is back from the shop.
There we go.
All
Let
right.
us know. Thank you so
Peace
much.
out. Take care.
Thank you. Take care.